Hello, good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here again. So today will be the Tuesday. Very good morning, 7th of May 2024. So as usual, before we start our Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. All right, as well as, give me a minute. Sorry, I think my screen is frozen at this point in time. Let me do a test for a while. Hope that everything is okay. Yeah, so I think everything is okay. Yeah, so yeah, back to the disclaimer. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. Okay. Now, before we jump straight into the short-term technical outlook on the various cross-asset classes, now let me have a quick walkthrough of what has taken shape yesterday in terms of the cross-asset performance, and in conjunction to the news flow and economic data that has been playing out in the global markets. So firstly, we do have a positive spillover on the US stock indices, the major stock indices per se. A positive feedback loop from last Friday. So all the major US stock indices continue to bask in a bullish limelight after it slightly breached above the 50-day moving average on the SPX and the Nasdaq 100, but not on the Dow Jones Industrial Average. So let me share with you before the technical configuration. Let's take a look at the price performance of the major US stock indices, as you could see on my screen over here. So this is the SPX 500. So all of them actually rallied, and the rally actually took shape, very interestingly, the last 30 minutes of the price. Okay, so some of y'all may view it as those zero dated option that is actually causing this push up flow possible, but it actually took shape. All of them, that short spurt of the rally took shape in the last 30 minutes of the market close, before the market closed. This on the S&P 500 gaining 1%, and the Nasdaq 100 gaining 1.13%, and the Dow Jones Industrial Average not that great, only gaining 0.46%. All right, and the top performer is the Russell 2000 gaining 1.23%. And one of the fundamental narrative that is supporting this yesterday's push up in the US stock indices is there is still a chance of an interest rate cut in the US economy, and engineered by the US Federal Reserve after Fed Chair Powell kind of a dovish press conference to keep the hopes of an interest rate cut alive, and market continue to actually bask in the limelight of a weak non-farm payroll data, but they actually choose to ignore the fact that stagflation risk is still around, because ISM services prices PMI and ISM manufacturing prices, the subcomponent of the PMI for both the manufacturing and the services for April, continue to tick upwards. So that particular chart I already covered in yesterday's Daily Dose. For those who actually miss it, could actually look at the Daily Dose recording or the YouTube video that was published in our OANDA Asia Pacific YouTube channel as well. So I will not touch on that. All right, but I want to touch over here is yesterday there's this Federal Reserve official speaking. Yeah, but the market also choose to ignore. Why? Because the Federal Reserve official speech yesterday, he did mention that not very dovish, because this Fed banking, he's so concerned about the risk of services and housing inflation. All right, so he's not pretty much certain that the Fed will be 100% cutting in 2024. Yes, there could be a chance of a cut, but on the other hand, he's pretty much saying that there's still risk of continuing housing and services inflation will keep price gains elevated. All right, so that is actually at the back of his head. He's still mindful about that stagflation risk scenario, which I also highlighted yesterday, based on the ISM services subcomponent PMI and the ISM manufacturing prices subcomponent PI data that is trending upwards. And also oil prices may start to gain another round of impulsive up move after Israel yesterday saying that the ceasefire plan backed by Hamas fell short of Israel expectation. So the war cabinet of Israel saying that Israel will continue its operation in Rafah. That means there's going to be ongoing assault by Israel in the Gaza Strip, because despite Hamas saying that they want to cease fire, but Israel saying that the plan falls short of its expectation. So there's a high chance that geopolitical risks will continue to be on the uptick again. And most interestingly, from a technical perspective, that related to oil price. If you look at oil prices over here, oil price yesterday, after that news flow came out, it managed to stage a rebound right off the lower limit of this medium term ascending channel that I drew from the low of December last year, 78.40 medium term pivotal support level, and the RSI is all turning upwards from its oversold region. Okay, so for sure over here is that the trigger level for that breakout is 80.80. So if it starts to clear above 80.80, that potential leg of medium term impulsive up move sequence potentially could resume for West Texas oil. Then the next resistance to watch out for sure, the 87.70, then thereafter followed by 90.70, the top of the channel. Okay, so something to be mindful: if oil prices going to go up, inflation expectation in US will also starts to increase as well. Why? Because if you look at this chart that has been flashed out, all right, for some of my daily dose, is that the inflation expectation in US as driven by the 5-year and the 10-year break-even rate, orange and green. So view this as this break-even inflation rates is derived from the treasury inflation protected bond prices, is market tradable, and is derived from there. View it as inflation, future inflation 5-year from today and 10-year from today. So that's called inflation expectation, and they move hand in hand with oil prices. And the last few days, inflation expectation came down. Why? Because the last, I'll say 1.5 week, it came down in line with that pullback in the oil price. So if oil price starts to stage that rebound up from 78.40, like I highlighted to you all, that's West Texas crude oil on my chart earlier on, it will actually see a positive uptick in the 10-year and 5-year inflation break-even level. That means higher inflation expectation in US. And also the 5-year and 10-year break-even has a direct correlation with the US 10-year Treasury yield. So with that in mind, that US 10-year Treasury yield was potentially continue to see that uptick as well, if inflation expectation as as indicated by the break-even inflation rate continue to stage a rebound, or driven by the possible conduit from higher oil prices. Why? Because geopolitical premium positive has started to potentially creep back into the market after that ceasefire, we call it trounce between Israel and Hamas seems to be now on the back of the wagon instead. All right, after Israel yesterday refusing to actually back Hamas, we call it a carrot, or take carrot and decided to continue their operations in the Gaza Strip. So something seems to be aware of, but that is not being priced into the stock market right now. All right, so stock market going to be very jubilant. Okay, but what's being priced, what's being expected over here is that the US FX market seems to be actually uh, acknowledging this potential rise in geopolitical risk premium by bidding up dollar strength. Okay, if you look at the FX market over here, okay, whoops, where is it? Yeah, okay, so if you look at the 5-year, not 5 year, pardon me, 5-day rolling performance of the dollar against the major currency. As of now, the dollar strength seems to be creeping back into the picture after that initial sell-off, that short-term sell-off that was seen in the later part of last week, ex-post FOMC and ex-post NFP data release, and it starts to actually recover back some of the losses, right, by turning up. Right, so it seems to me that the dollar FX market has now started to price in this potential uptick in oil prices, which could actually lead to a uptick in inflationary expectation in US, and also a reversal of that US 10-year treasury yield after pulling back in the last 1.5 week. And very interestingly, if you look at the US 10-year treasury yield now, it's still holding firmly at the, this is the dollar index rebounding from the 50-day moving average, which is bullish, and the 10-year US Treasury yield continue to hover. Where is it? Okay, it's a bit. Yeah, this is the 10-year Treasury yield. Okay, why is it not? Okay, give me a minute. Okay, sorry, this is the one. Okay, it continues to play around the 4.5%, but still holding above the 4. Okay, the key support level is 4.32% to maintain this ongoing medium-term uptrend that is in place since the low of February this year, which is this ascending channel that is in play, and 4.32% also confluence with the 200-day moving average. All right, so now it's actually trying to flirt around the 4.5% level. Now it's trading about 4.9%. So if it starts to inch down slightly lower, I'm actually looking at this 4.32% level. Okay, so now the key thing over here is, as long as 4.32% holds, the medium-term uptrend for the 10-year US Treasury yield still intact, and in order for it to see short-term momentum coming back into the picture, it got to start to break above this level here, 4.6%, which is the 20-day moving average. That means a recapturing of the 20-day moving average at 4.6%, a break above it could more or less solidify the return of that bullish tone for the medium-term uptrend phase, or the impulsive up leg of the medium-term uptrend phase. I want to be more precise, for the 10-year US Treasury yield to come back into the picture. So that also supports the dollar strength movement. So what you could see over here is that the geopolitical risk premium impacting potential higher oil prices being supported, which in turn starts to see potentially could see an uptick in inflationary expectation in US. This particular interplay of market movement has been kind of feared or priced into the FX market right now, because dollar strength seems to be coming back. But dollar strength coming back is not being felt in the US stock market. Why? Because the US stock market continues to be very jubilant on the prospect of earnings growth from AI related company. Why? Because if you look at the heat map of the S&P 500 yesterday, most of the stocks has been driven by the mega cap 7 stocks, all on AI related story. Meta up 3%, Microsoft up 1.7%, Nvidia, the strongest performer, up 3.8%, but Apple down almost negative 0. Down almost 1%, negative 0.9%, due to the negative news flow on the weekend, where Warren Buffett holding company indicated its continue, we call it underweightage, or selling, or it continued to show off its significant Apple holdings. So that created the negative feedback loop in Apple. But nevertheless, if US 10-year Treasury will continue to rebound, potentially that ongoing bullish optimism in the major US stock indices, very likely it could also shape that bearish reversal as well, because I do believe that all markets are interlinked at this juncture. All right, so with that, that actually sums up for yesterday's key data point, as well as events down to highlight, and as well as how does it link up from the intermarket and longer term fundamental perspective. All right, by looking at the charts. All right, so now let's now start with jump straight into the short term technical outlook. Okay, so this will be much more on the intraday basis. All right, so now let us start with the FX market first. All right, okay, so Asia. Okay, so Asia FX market, let us start with the Aussie dollar. Why is it? Because the Aussie dollar, after, as we are speaking right now, later around 12, okay, let me have a quick look. Yes, today is Tuesday. Okay, so RBA will actually release its decision at 12:30 p.m. Singapore time. So market is actually expecting no change to its concessions at 4.35%, but the ongoing rally that was seen in last week has been pretty much priced in by this potential hawkish vibe that is going to be peppered in the accompanying monetary policy statement of RBA. Why? Because of quarterly inflation in Australia managed to be much hotter than expected, but that seems to be already priced into the Australia dollar pair, because the particular movement of that thing starts to take up. But unless we start to see in this monetary policy statement, there is very high chance that the next move will be an interest rate hike instead in Australia, rather than a cut, or rather than the same stance where the RBA officials continue to give an open-ended verdict. That means data dependent to actually determine their next step in terms of the monetary policy. So the big caveat over here is, unless the monetary policy statement is going to be very, very hawkish, that means indication to us that the next move is a hike rather than a cut. So that could see the Aussie dollar rallying up very strongly. But that tends to be a very strong wording. Why? Because that actually goes against the thinking of other major central bankers right now. Okay, so from a technical perspective over here, let's quickly look at the Aussie dollar. Okay, the Australia dollar. Okay, now let me expand my screen so that you guys could see. So the Aussie dollar yesterday, we will actually have that bearish bias, short-term bearish bias for that pullback to take shape. 66.45 was our short-term pivotal resistance. No change. This morning it retested again before inching back down slightly. And what we could see over here is that the momentum is weakening as well by this consistent bearish divergence that's being flashed out on the hourly RSI lower high. Okay, while price action showing similar high at the 66.45 short-term pivotal resistance. So no change, 66.45 short-term pivotal resistance. Still maintain that short-term bearish bias for that potential corrective minor pullback to unfold within this short-term bullish ascending channel that I drew from 19th of April. First support level to watch 65.75. Below it exposes 65.20, which confluence with the 200-day and the 50-day moving average, all coming to act as a support at this 65.20 level. Graphically is the minor swing low area of 2nd of May, and as well as the lower limit of this minor ascending channel that I drew from 19th of April. Only an hourly close above 66.45 invalidate this minor corrective pullback bearish bias scenario to potentially see a squeeze up towards the next resistance level at 66.80, followed by 67.30. So 67.30 is a key medium term resistance for the Aussie dollar. Why? Because if you switch to the daily chart, 67.30 is the upper limit is of this ongoing symmetrical triangle range configuration that is in place since the low of 13th of October last year. So the upper limit of this symmetrical triangle range is now acting as a resistance at 67.30. So that actually be our medium term resistance level to watch out for. Now for the Aussie, the dollar yen. So dollar yen yesterday we flipped to a bullish bias for the recovery scenario. So price action actually indeed push up higher and clear above the first resistance at 154.25 for today, right, and a clear hourly close above it. So with that, I'll be having a slightly tighter key short-term pivotal support right now at 152.90. So first support level to watch for today for sure will be this level here, which today's intraday Asia session low at 143.90. So I don't put it as so tight at 143.90. I will use 152.90 as my short-term pivotal support level. So any potential pullback, as long as it didn't break 152.90, still maintain that short-term bullish recovery scenario on the dollar yen. Next resistance level to watch for sure will be 156 figure level. Above 156 figure level exposes 157.90, okay, which is that swing high of 1st of May that triggered that second leg of steep sell off. Okay, so this is another potential so-called rumored intervention by MOF in Japan. Only an hourly close below 152.20 will invalidate this short short-term recovery scenario on the dollar yen to actually see the continuation of this corrective decline, exposing 15160, 150.80, which is the 50-day moving average as well. Now, European currency. So on the British pound, sterling dollar. So sterling dollar managed to actually continue to print a slightly lower high below the 12640 short-term pivotal resistance level. So no change, still using 12640 as my short-term pivotal resistance level. Maintain that potential bearish bias coming back into the sterling dollar. Why? Because if we look at the RSI seems to be right now breaking below this ascending trend line support level. Okay, and now traded back below the 50 level mark, okay, indicating to us that some signs of short-term bearish momentum creeping back into the sterling dollar. So first support level to watch in the near term, 12540 on the intraday basis. A breakdown below it exposes 12460 next in the near term. Only an hourly close above 12640 will invalidate this short-term bearish bias to see the continuation of this counter trend rebound scenario within its sideways range configuration in the longer term. Next resistance to watch out for will be at 12710, followed by 128 figure level on the sterling dollar. Then with that, on the euro dollar, yesterday we flipped to a neutral bias below that 108 level, and very similar as well, the RSI also starts to shape that bearish breakdown. All right, so with that, we'll be flipping to a short-term bearish bias on the euro dollar using 1.08 as a short-term pivotal resistance level. First support level to watch will be at 1.0730 for today. Only a breakout above 1.080 will invalidate this short-term bearish bias to see the continuation of this counter trend rebound. Next resistance level to watch 1.0850, followed by 1.0880 on the euro dollar. Okay, so overall net we do see a bit of dollar strength coming back into the FX market based on the short-term technical configuration on the respective major FX pair that I shared with you earlier on. Now, major stock indices. Let us start with the Nikkei 225. So Nikkei 225 today, the Japanese stock market is open, the cash market is open. So I could see is that yesterday's grind up managed to actually see that sell off right below that 38,800 short-term pivotal resistance that we highlighted. So there's a bit of excess yesterday at 9:30 during the US session, 38,930. We also confluenced with the descending trendline resistance from the high of 22nd of March. So still maintaining that short-term bearish bias over here. Why? Because if you look at the RSI also has started to break down below the trendline support as well. Okay, so as long as the excess 38,800/930 short-term pivotal resistance is not surpassed, still maintain that short-term bearish bias within this sideways range configuration. First support level to watch on the intraday basis, 38,330, followed by 38,010 level. Okay, for today, only hourly close above 38,930 will potentially see a squeeze up towards 39,110, followed by 39,480 in the first step. No change on the Hong Kong 33, looking for that pullback to take shape. So price action going to actually be lackluster below the 18,800 short-term pivotal resistance that were highlighted on Monday. So no change as well. Maintaining 18,800 short-term pivotal resistance level on the Hong Kong 33 for that potential minor pullback scenario to play out. Support level to watch on an intraday basis, 18,000/17,900. Only an hourly close above 18,800 will see the continuation of the impulsive up move towards the next resistance level at 19,390, followed by 19,980 next. 1.618 Fibo extension from the low. Okay. Okay, 1.618 from the low of 22nd of January, and as well as the congestion area over here on 1st of August. Okay, so no change on the Hong Kong 33, aka Hang Seng Index, as long as it didn't surpass 18,800, potentially still maintain that bearish bias minor corrective pullback scenario. German 30. So German 30 yesterday we flipped to a bullish bias within its potential symmetrical triangle range configuration. You could see on my screen over here, similar high at 18,010, but higher low since the swing low of 25th of April. So it's like a symmetrical triangle range configuration that is congestion right now. So what you could see over here is very interestingly, it almost hit the 18,810 level, which is the upper limit of the symmetrical triangle range configuration, and the RSI is also at the overbought region. Okay, so with that, we will be flipping back to a bearish bias within this symmetrical triangle range configuration. 18,310 for sure, short-term pivotal resistance. First support level to watch, 18,150. A break below it exposes 18,030, which is the lower limit of this symmetrical triangle range configuration as well. If I draw the graphical trend line support level for you all to see, okay, 18,830, and as well as the 50-day moving average also acting at a similar support at 18,030 level. Only an hourly close above 18,310 will invalidate this short-term bearish bias to see the potential bullish breakout unfolding for the next impulsive up move that may take shape. Next resistance to watch in the short term will be 18,400 followed by 18,490. That's for the German 30. Then for the US Wall Street 30, the Dow Jones Industrial Average, so I could see yesterday we will have that neutrality stance on the Dow Jones Industrial Average. So yesterday price action has started to shape a bullish divergence on the RSI. Okay, price action shape higher high, but RSI is going to shape lower high. Okay, so with that, I'll be using 39,500 as my short-term pivotal resistance level. Potentially look for a kind of a minor pullback scenario to unfold first in the first step. First support level to watch, 38,560. A break below it exposes 38,3310, potentially on an intraday basis, also corresponding to the 20-day moving average acting as a resistance as well. However, a breakout above 39,050 will start to see the start of a very, very strong potential bullish up move on the US Wall Street 30. Next resistance to watch out for will be at 39,380, followed by 39,775. Okay, so for the US Nasdaq 100, yesterday we were neutral, so price action squeezed up, broke above the upper neutrality limit, and now almost coming close to the resistance level that is actually highlighted yesterday at 18,180. So what's 18,180? A one-time Fibo extension of this ongoing up move from the low of mid-April over here, and as well as the descending trend line resistance that I drew from the current all-time high of 21st of March, all right, at 18,080 as well. So 18,080, also the minor swing high of 15th of April. So using 18,080 as my short-term pivotal resistance level for today, potentially flip to a bearish bias for a minor pullback scenario in the first step. First resistance to watch 17,940, which is the 50-day moving average, acting as a support. A break below it exposes 17,810 level. So in order for the best to gain more traction, it got to actually break down below 17,080, which is the swing high area of 29th of April, to expose the 20-day moving average at 17,685. However, an hourly close above 17,950 will invalidate this bearish bias to kickstart another strong bullish movement of the Nasdaq 100, potentially sees the next resistance coming in at 18,380, followed by 18,500, which is the current all-time high area for Nasdaq 100. Now for spot gold XAU/USD, no change, continue to remain pretty steady above that 2065/2260 pivotal support level that I highlighted. So it's continued to actually trade up higher within this impending bullish descending wedge configuration, but still, because it's still inside this wedge and isn't broken above 2365 level, I don't want to tight that short-term pivotal support level too tight at 2290. So I'll still maintain this 2265/260 pivotal support level. As long as this level holds, still looking out for that potential recovery scenario for gold to unfold, XAU/USD. A clearance, first resistance you got to clear will be at 2365 level, which is this former congestion area here, and an hourly close above 2365 will kind of increase the odds of the start of this bullish bias scenario. First the next resistance to watch out for will be at 2004.20 in the first step for spot gold. However, an hourly close below 2265 will negate this bullish bias scenario to see a test on the next support level at 2235/2210, which is also confluence with the upward sloping 50-day moving average as well. Okay, so still maintain that short-term recovery scenario that is potentially unfolding in spot gold XAU/USD. So earlier on, I touched on the West Texas crude oil on the daily chart. So no change for West Texas crude oil using 78.40 as a medium-term pivotal support level. Price action continue to inch higher on the RSI, also supporting that kind of a short-term bullish momentum creeping back into the picture. So first resistance to watch out for definitely for sure will be the 80.80 level slash 81.50 level, which is the 200-day moving average. So a kind of clearance above 81.50 level will kind of increase the odds of this short-term recovery scenario in West Texas oil. However, hourly close below 78.40 will invalidate this short-term recovery scenario to see the extension of this corrective decline to expose the next support area at 76.90 followed by 75.50 level. Okay, so that's pretty much sum up for the short-term technical outlook on the broad-based cross asset classes for today. So before we go, let's take a quick look at the calendar. So other than RBA interest rate decision that's out at 12:30 p.m. Singapore time later today, the next data point to look out for will be in Europe. So in Europe over here, retail sales for month of March will be out later at 5 p.m. Singapore time. Then thereafter, a pretty much quiet session in the US session, nothing clear to look out for. Then thereafter, what we have over here is, yes, at 11:30 p.m. there's a Federal Reserve official speaking, Fed of official Kaskari. He will be speaking at 11:30 p.m. Singapore time. Then that should actually sum up for the key economic data and events to look out for today, and also definitely the ongoing fluid situation in the Israel Hamas conflict. So any potential flare up from there after Israel refusing to actually sign that so-called agreed to that ceasefire initiative as initiated by Hamas. Any we call it increase in hostility in the Middle Eastern region should actually potentially impact oil prices as well. So something to look out for today. So with that, have a great day ahead, and we shall speak again tomorrow. Thank you.